I spoke to quite a few asset managers today. One even described it as expecting a dove, but finding a hawk underneath the dove costume. What did you make of it?
I think that she was basically trying to manage expectations. I think the problem was that going into this meeting, both the market's expectations and the Fed's own expectations were quite in line, and they were relatively benign. Now, clearly we've had this period where the data's been impacted by the poor weather, but we're working through that now, and it's beginning to pick up. And I think that last night's adjustment to the projections, so the lower unemployment rate forecast, the higher interest rate forecast, reflect the fact that maybe there's some increasing concern that they've underestimated the tightening conditions in the labour market. I mean, after all, we did see in the last payrolls report the average earnings growth beginning to pick up. That may be a blip, but it's also interesting how in the last sort of employment cost index, earnings growth was also picking up slightly there. So I think the Fed's very concerned about any sort of pickup in wage growth being sustained going forward, and they just want to sort of manage the market in terms of maybe we have to hike a little bit sooner potentially, or a little bit more aggressively.
Right. So they're managing expectations. We saw yields spike. Does this mean we'll see 2-year and 10-year yields go up even further?
I'm sure they won't be happy with the sort of pressure we've seen on yields, particularly if it's sustained. But I think that what we've seen is in the bond market, both at the short end and at the longer end, yields were at the sort of low end of the trading range, so they were vulnerable to a little bit of upward pressure, particularly if the data started turning round anyway. We've seen this process get underway now, yields rising on the back of the statement last night, but I don't think we're going to start seeing a sustained sell-off from here, purely because we've got this ongoing issues in the Crimea. We've got the market looking at potential slowdown in China. So those background issues will constrain any sell-off in yields. So what we'll probably see is the bond market moving towards, in terms of yields, the top end of its trading range. So in the 10-year, for instance, I suggest that would mean a level closer to 3%, yes.
Right, and for the 2-year?
2-year, we're currently just above 0.4% or so. I think we can move up to the sort of 0.5, 0.6% range, potentially in the short run, if the data starts picking up as well in the next few weeks.